if the house is occupied by the owner, then it is also exempt. Need not to compute income from house property because it is occupied by the owner. He paid 3,000 rupees of municipal tax. Deduct 3,000, whatever the balance you will get. From this 30 deduct 3,000, the balance you will get is 27,000. Second house, self-occupied. It is occupied by the owner. So what is the format? Directly we will go with annual value. Annual value is nil because he is not receiving any rent. Hello everyone, I am Arun Kumar, lecturer in Department of Commerce and Management, Vidhyaashram First Grade College, the Temple of Excellence, Mysuru. Dear students, welcome to this new session on unit number 3, session 1 on topic income from house property. Yes, dear students, in this particular session we are going to learn about what is income from house property and how to compute the income from house property and what is gross annual value, what is actual value, what is fair rent, what is actual rent and what is standard rent, what is municipal rent. So we are going to learn about this all aspects in this particular session, and we are also going to solve two problems with respect to this particular topic. So dear students, firstly we have to understand what is this income from house property and under which section this income from house property comes under income tax. So income from house property comes under section 24. Okay. So for example, if you have any house, if it is occupied by you, okay, you have your own house and it is occupied by you, okay. If it is occupied by you, you can't earn any profit from that occupied house. So the point will not arise. Computation of income from house property, that point will not arise since you are not earning any profit in that house. In case if you have two houses, one house is occupied by you and another house is let out. You had given it for rent. Okay. So now what you are receiving from let out property? From let out property from tenant, what you are receiving? You are receiving rent every month. Let us say you let out a property for 10,000 rupees per month. How much? For rupees 10,000 rupees per month. So from let out property, how much you are receiving? 10,000 rupees per month into 12 months. So how much? You will be receiving 1,20,000 rupees per month from that let out property, right? So that 1,20,000 is profit for you, isn't it? Yes, that 1,20,000 is profit. So on that profit you are supposed to pay tax to the government, right? On that 1,20,000 you are supposed to pay tax to the government. So in this particular unit under income from house property, we are going to learn about how to compute the income from house property, because whole 1,20,000 is not your profit, right? You will be spending some money for repair, or you might paying some interest on the loan taken for the purpose of construction of the house. You might pay municipal tax, right? You will be also having so many expenditures that whole 1,20,000 is not your profit. So in this particular chapter, we will be learning how to compute, how to adjust all the adjustments with respect to income from house property. So this particular income from house property deals with section 24. So determination of annual value. Yes, we are going to determine the annual value under section 23. So I'll explain you in the next slide about this particular thing, that is annual value. Let out property. So we will be computing the let out property under section 23 subsection 1. Property occupied by the owner, it comes in section 23 subsection 2. Property owned by co-owners, it comes under section 26. Interest on housing loan, yes, it is a deduction which comes under section 80 EE. And unrealized rent allowed, it comes under section 25A, and unrealized rent received, section 25AA, and taxation of arrears of rent, section 25B. So these are the different sections which deals with house property. Okay. So for example, determination of annual value, we are going to determine the annual value on the basis of the rules which are there under section 23. So these are different sections what we have. for different scenarios which comes in income from house property. Exempted items. Yes, exempted items under house property. The house was not let out. Yes, if the house is not let out, then it is exempted from tax. We need not to calculate the income of that particular house. So if any house is not let out, it is exempt, need not to calculate. Next, income from one self-occupied house. Yes, if the house is occupied by the owner of the house, if the house is occupied by the owner, then it is also exempt. Need not to compute income from house property because it is occupied by the owner. Okay, it is occupied by the owner. Next, registered trade union. Yes, if the house is given for rent by the registered trade union, then it is also exempt. Next, the annual value of any one palace in the occupation of an ex-Indian ruler. Yes, if any ex-Indian ruler is occupied any palace, that one palace is exempt from tax and he need not to pay tax to the government. Income from property owned by local authority. Yes, if the local authority is earning the income from any property which is owned by the local authority, that will also be exempted under income from house property. Next, income from property owned by games association. Yes, if income from house property owned by association, it is also exempted. Next, a person resident of Ladakh. If any person is resident of Ladakh and if he is receiving income from house property, then it is also exempt from income from house property. Moving further, gross annual value. Yes, it comes under section 23 subsection 1. So the gross annual value will be based upon these 4 components. Okay, these 4 components. So we are going to find out the gross annual value based upon the 4 components. Which are those 4 components? That is rent payable by the tenant, that is called actual rent. Actual rent is nothing but the rent payable or paid by the tenant. Next, municipal valuation of the property. Yes, whatever the property is valued by municipal corporation, that is called municipal value. And fair rental value, that means rent receivable for a similar property in the same area. So if you are in one particular area, there the actual rent is 10,000. The actual rent is 10,000, that is whatever the rent you are receiving is 10,000. But the fair rent there in that particular area is 15,000 because the similar property they are receiving rent of 50,000 but you are receiving only 10,000. So this 15 is called what? Fair rent. That means the value of the property, the similar properties in the same area, that is called fair rent. And standard rent payable under the Rent Control Act. Yes, the Rent Control Act, that authority is going to fix a standard rent. That is, like for example, 8,000. You can't take less than 8,000 for that particular area. That is called standard rent. So based upon these 4 factors, we are going to find out the gross annual value. Now, how we are going to find out the gross annual value? We have a simple trick to find out the gross annual value for computation of income from house property. So what is that simple trick? So very easy. So 4 components are required. What are those 4 components? Yes, municipal value and fair rent. Municipal value and fair rent. So first, for example, municipal value 10,000 and fair rent is rupees 20,000. Okay, municipal value is 10,000, fair rent is 20,000. So first, in these 2, whichever is high. Whichever is high. So in this 2, which is the highest value? 20,000. Okay, rupees 20,000. Right. So 20,000. Compare this 20,000 with standard rent. Compare 20,000 with standard rent. So for example, standard rent is rupees 25,000. rupees 25,000. Now in these two, whichever is low. In these two, whichever is low. So which is the lowest amount in these two? It is, yes, 20,000. 20,000. So now compare this 20,000 with actual rent. That is rent received. Actual rent. So what is the actual rent? For example, say 30,000. 30,000. So now in this two, whichever is high. Whichever is high. So which is the highest amount? Yes, it is 30,000. So this 30,000 is called what? Gross annual value. Gross annual value. Very easy. So to find out gross annual value, if the four informations are given like municipal value, fair rent, standard rent and actual rent, just have to follow this format. Okay, these steps. So first municipal value and fair rent, in these two whichever is high. Okay, so take the highest value here. Next compare with standard rent, whichever is low, take the lower value here and compare with actual rent, whichever is high, take the higher value. That higher value will be the gross annual value. So it is very easy, need not to worry about it. It's very easy to find out the gross annual value. In some cases, you will be giving only few informations like municipal value, fair rent and actual rent. Okay. If the standard rent is not given, only municipal value, fair rent and actual rent is given. In these three, whichever is high. Need not to go with step 1, step 2, step 3. Directly in these three, whichever is high. So got it? Yes. So if all the four informations are given, we go with step 1, step 2, step 3. If only 3 informations are given or only 2 informations are given like municipal value, actual rent, in that two whichever is high. Or if 3 informations are given, municipal value, fair rent and actual rent, whichever is high. So this is how you are supposed to compute the gross annual value with respect to income from house property. Next, from gross annual value, if you deduct municipal tax, so less municipal tax paid by owner. So the municipal tax should be paid by owner itself. So if the municipal tax is paid by owner, deduct municipal tax. Let us say he paid 3,000 rupees of municipal tax. Deduct 3,000. Whatever the balance you will get from this 30, deduct 3,000. The balance you will get is 27,000. This 27 is called annual value. Very easy. Annual value. You want to find out the gross annual value. From gross annual value, less municipal tax paid by the owner. Whatever the balance you will get, balance is called annual value. So from annual value, we are going to deduct the deduction under section 24. So now let us solve the first problem. So compute taxable income from house property from the following particulars. Yes, fair market value is given, actual rent is given, municipal value is given and standard rent is given, municipal taxes is given and interest paid is given. By using this information, we are supposed to solve the problem. So how to find out gross annual value? So here fair rent is given and municipal value is also given. So what is the municipal value? Yes, first write down the municipal value. Municipal value is how much? It is rupees 50,000. Right? 50,000. Next, fair rent is given. That is fair market rent. So fair rent is given. What is the fair rent? It is rupees 80,000. So in these two, whichever is high. So which is the highest value? 80,000. Right? Next, compare 80,000 with standard rent. So what is the standard rent given in the problem? 60,000. So 60,000. In these two, whichever is low, which is the lowest value? 60,000. So compare 60,000 with actual rent. So what is the actual rent? It is 72,000. Right? 72,000. Whichever is high. So which is the highest value? 72,000. So this 72,000 is called what? gross annual value. We will call it as GAV, gross annual value. Okay. So this is how we are supposed to find out. So we find it out the gross annual value. So now we will solve the problem. Here you can see the gross annual value, right? Gross annual value rupees 72,000. So from gross annual value less municipal tax, 20% of 50,000. So then what is this 50,000? That is municipal value. On municipal value we are paying 20%. So deduct 20%. Sometimes he will only give the value, municipal tax 3,000, 10,000. Sometimes he will give percentage. So 20% on 50,000 you will get 10,000. Deduct 10, you will get balance of 62,000. This 62 is called what? Annual value. So from annual value less 30% of annual value. So that is the standard deduction. 30% of annual value is the standard deduction under section 24. So 30% of annual value, compute 30% on 62,000. Here you will get 18,600. And interest, yes, interest is given in the problem 18,000. So write down that 18,000 interest and totally deduct 36,600 from 62. You will get balance of 25,400. The balance of 25,400, that is called income from house property. The 25,400 is called income from house property. The format is very simple. First find out gross annual value. From gross annual value deduct municipal tax paid by the owner. Balance you will get. This balance is called annual value. From annual value less 30% of annual value, and less if any interest is paid. You will get the balance. That balance is going to be your income from house property. Very simple. So next, moving on to the next problem, the second problem. Sri Lakshmi is the owner of 3 houses. The following are the particulars of his properties for the year ended 31st March 2020. So they have 3 properties, house 1, house 2, house 3. Okay. Year of construction 2010, 14 and 2016. Purpose of use. So purpose of use, yes, this is for let out. This is self-occupied property and this is also let out property. So this is let out property. So house 1 and house 3 are let out. House 2 is self-occupied property. So actual rent. So from house 1 she is receiving 15,000. House 2 obviously self-occupied, she will not be receiving any rent. And here house 3 1,000 rupees per month. Municipal valuation 16, 12, 30,000. Total municipal tax 1,600, 1,200, 3,000. Paid by Lakshmi, that is by owner, it is 800, 1,200, 3,000. Paid by tenant, the person who came for the rent. So paid by tenant 800, nil. And next, fire insurance premium 2%, 2%, 2%. And interest on loan taken for renewal of house. Yes, 7,000 for self-occupied, house 1 and house 3 is nil. Fire insurance premium or whatever the other additional expenditures are incurred, that should not be considered. So whatever I told, that should be considered, only that much should be considered to compute the problem. So first one, house 1. So house 1 is let out to bank. So now we will be computing the gross annual value. So in this particular problem, he had given only 2 informations, which are those actual rent and municipal value. Actual rent and municipal value is given. Fair rent and standard rent is not given. So in these 2, in municipal value and actual rent, in 15,000 and 16,000, whichever is higher. So 16,000 is the higher value. This is called gross annual value. Next, less municipal tax paid by landlord, that is by owner. So what is the municipal tax paid by the owner? By Lakshmi, it is 800, right? So deduct 800, you will get balance 15,200. This 15,200 is called what? Annual value. So from annual value less 30% of annual value. So deduct 30% on 15,200, you will get 4,560. Okay, so 4,560. 4,560. So deduct 4,560 from 15,200 because interest on loan is not given to deduct on house 1. So balance 10,640. 10,640 is what? Income from house 1. Income from house 1. Next, second house. Second house self-occupied. It is occupied by the owner. So what is the format? Directly we will go with annual value. Annual value is nil because he is not receiving any rent. Right? Annual value is nil because he is not receiving any rent. Next, less 30% of annual value. In that, interest on loan is given. You can see here, interest on loan is how much? 7,000 on self-occupied property. That loan value will be the expenditure for him. So we will be deducting it under section 24. So in 30% of annual value, we will be showing 7,000, that is interest on loan. So this 7,000 is going to be loss from self-occupied property. So this 7,000 will be the loss from self-occupied property. So next, house 3, third house, that is also let out. So in two values, in 30,000 and 36,000, whichever is the higher value, that is on municipal value and actual rent, 36 and 30,000, whichever is higher. 36 is the highest value. This 36 called what? Gross annual value. So less municipal tax paid by the owner. Yes, it is given in the problem. What is the municipal tax paid by the owner? It is 3,000. So municipal tax paid by the owner is 3,000. So now write down 3,000. So 36 minus 3 balance 33,000. This 33 is called what? Gross annual value. So from annual value less 30% of annual value, that is 9,900. If you compute 30% on 33,000, you will get 9,900. So deduct that, balance you will get 23,100. That is income from house 3, 23,100. So now set off the income and loss of house 1, house 2 and house 3. So here in house 1 you have 10,000 profit, house 2 you have loss of 7, house 3 you have profit of 23,100. If you set off loss from those two incomes, you will get balance of 26,740. Okay. So 23,100 plus 10,640 minus 7,000. You will get 26,740. So this is the total taxable income from house property. So this is how you are supposed to solve the problem with respect to income from house property. It will be very easy to solve the problem. The thing is, just you have to follow the format. So with this, I am going to wind up this session. In the upcoming session, I am going to solve few more problems with respect to income from house property. Until then, thank you all. Have a nice day. Namaste.